Hello and welcome. My name is Sean Giroux with IMS Associates. I'm going to be host for you today on our Living Benefits Life Insurance webinar. Do appreciate everybody ringing in today. We're going to try to get this through in about 30 minutes or so. Any questions that you guys have, please do just make notes of that as we go here. We will be doing a Q&A at the end of the webinar and got a lot to cover, so I'll try to get through that pretty quickly, and then hopefully we'll have a decent amount of questions there at the end. So before we get started here, we wanted to go through just a quick bit here on IMS Associates in of itself, who we are. I think most of you are probably familiar with us, but those of you who aren't, we are a one-stop organization. We're an IMO or a general agency doing life insurance, long-term care, and annuities. We also do disability income and life settlements. And we were founded in 1986, licensed in all 50 states, and we are headquartered in Orange County, California, and currently contracted with over 40 of the industry's top carriers. But enough about us. Any other questions on what we're doing and what exactly our role is in the market, please feel free to shoot me a call or give me an email after the webinar. So I'm going to start you guys today with some basic definitions to get a frame of reference here as to what exactly we're going to be speaking about and what we're referencing as the webinar goes on. These are the living benefits and linked benefits product there. Living benefits and linked benefits are really interchangeable terms. I think primarily you're hearing more living than linked benefits, but there are a few carriers who reference it as linked benefits. We're going to reference it as living benefits here on out, and by definition, that is really no cost built-in, or no cost riders, that are built into life insurance policies and are being offered by several major insurance carriers. The policies typically include 4 benefits, so we have a 4-in-1 concept that you see marketed between life insurance, critical illness, chronic illness, and the terminal illness benefits. Those benefits mentioned above do allow the insured then to accelerate all or a portion of the death benefit for a qualifying event. So the base policy still is a life insurance policy, and essentially what the client has is an access to that insurance, that face amount, that quote-unquote death benefit for reasons other than death, the critical, chronic, and terminal illness benefits. So let's see what those are then exactly. I'm going to start off with critical illness. I know a lot of the carriers market terminal illness first, and I think that's maybe a little bit backwards. Terminal illness is probably the least favorable of the benefits. That's something you're going to see in a lot of base life insurance policies as it is. So for me, hey, that's a little bit of a taboo kind of a deal versus really what the sales pitch needs to be focused on. Critical illness is what we'll start with there. The death benefit can be accelerated for a qualifying event. This typically includes heart attack, stroke, invasive cancer, end-stage renal failure, major organ transplants, ALS or Lou Gehrig's disease, blindness, and paralysis. Now that's the core benefits you're going to see read into most of these policies we're going to be speaking about, most of the policies we market. You may see some auxiliary benefits depending on which product exactly you're working with. Severe burns, loss of limbs, etc., some of the other ones we have listed there. But that base core of triggering events we have listed in that first segment there, you will see in all the policies. The definitions between those and exactly how those are defined does vary a little bit from carrier to carrier. It is pretty uniform. There's not any huge discrepancies that's going to make one carrier significantly better than the other. But if you do put those under a magnifying glass, that they're not all equal. Some are slightly better than others. More than happy to go through some of that afterwards, or if you have any questions as to the benefits from carrier to carrier. Chronic illness is then the second one. This is essentially a long-term care definition. The death benefit can be accelerated for the insured if the insured is diagnosed as being chronically ill, prolonged chronic illness, disability, or cognitive impairment that prevents the insured from being able to do any of the 2 of the 6 activities of daily living, or the ADLs. Now the ADLs, or activities of daily living, include bathing, continence, dressing, eating, toileting, and transferring. On that front, a couple areas just to distinguish there, toileting versus continence. Continence would be bowel control or bladder control. Toileting would actually be the act of toileting in and out of the bathroom, up and down from the toilet, etc. Transferring is getting in and out of bed, to and from the kitchen table, in and out of the favorite recliner. This benefit, you may see it include an elimination period and a monthly maximum for the amount that can be accelerated each month. That's typically not how they read, but there are a couple products out there that do have an elimination period and monthly maximum. Terminal illness is the third here. Not to call it the last, but saving the last or the least for last here, but that's really kind of where we ended up on this one, to be honest with you. I do like this benefit. You can accelerate it up to 24 months versus, let's say, maybe a typical 6 or 24 month that you might see in a regular term policy. But if the insured is diagnosed by a licensed physician for being terminally ill with a life expectancy of 24 months or shorter, they would be able to accelerate that death benefit. A couple of the carriers, chronic illness, terminal illness-based care, or critical illness-based carriers, the one doing all three, do have a more limited terminal illness benefit at 12 months. But for the most part, we are seeing a 24-month benefit there. So what do your clients get then? Well, they get a whole heck of a lot of benefits here. You get one affordable policy that provides protection for a multitude of conditions. And every one of these conditions, maybe let's say minus the terminal illness benefit, are products that are currently being sold on a standalone basis by today's major insurance carriers. Death benefit, that one's obvious. For more of the life-based agents who aren't familiar with different health and supplement and accidental health policies, you may not be aware of it, but there are several chronic illness-based policies and critical illness-based policies out there. On the chronic illness side of things, well, hey, we'd mentioned that's essentially long-term care. So there's a huge market for every three of those as a standalone product, let alone rolling that into one affordable, easy, one premium kind of based policy. Benefits are available tax-free and, for tax-free at death, and or a qualifying condition. So how and why are these relevant? What I want to get across to you guys here is, understanding the frame of reference as to why these things should actually be sold, why you need to be discussing this with your clients. From your side of things, that ought to translate to why your clients should actually buy these products. If you can get familiar with some of these are real good to keep in your side pocket as you, do present these. So you're able to kind of rattle these off and give your clients some of these stats. It really can make a powerful presentation. Over 60% of the bankruptcies in the U.S. are attributable to major medical expenses. Over 60%. So this is something that's going to help people stay in their homes. Probability of developing invasive cancer as an American is 40%. Every 25 seconds, an American suffers a coronary event. Every 40 seconds, someone in the U.S. has a stroke. And nearly 75% of all Americans over the age of 65 will need long-term care. So that's, for me, when I read those things, it really puts into perspective how important these policies are, how important those benefits are, and really how obvious sometimes the decision can be to spend another 15-20% on premium to lock into these benefits if you're already at the door trying to sell a life insurance policy. So who can you write these with? I'd mentioned it before. We got a handful of carriers out there ranging, from a diverse portfolio there, everywhere from term insurance through to permanent policies. On the permanent side of things, we, between the carriers we work with, literally have every kind of policy you can need. We have GUL policies, IUL policies, current assumption policies, whole life policies, the whole gamut there. Carrier-wise, we're looking at American General Life and Accident, who's better known as AGLA, American National, again, better known as ANACO, Life of Southwest, who's typically referred to as LSW, and then Transamerica, who I call Trans, but I think most people still probably just call Transamerica. But let's take a peek then how that bunch compares. We really focus on three carriers there, AGLA, LSW, and Transamerica. AGLA, they do term, universal life, and IUL. Don't want to run through every single one of these rows and columns here, but kind of highlight what each one of these carriers is doing that maybe sets it apart. For AGLA, it is really good, well-priced term at a maximum of $1.5 million. In addition to that, they do a 35-year term product for those applicants in their 30s and 40s who may be more interested in locking in on something long-term without being, let's say, overly enthused to pay the premium on a permanent-based product. LSW. Now, LSW's market has really always been the IUL. I had a conversation with an agent, just a few weeks ago on this, and had mentioned they had term, and he was shocked. He'd been writing IUL stuff with them, and they just had never even realized they were term, doing term as well. They don't really market it very much, and their pricing, as you're going to see in some of our later comparisons, is really just not competitive. To be honest with you, they really just kind of have it almost as a conversion-based kind of a deal, and to pick up a little bit of business in addition to that. But their strength is really their permanent portfolio, and within that permanent portfolio, their strength is really their IUL. They have a very good IUL portfolio with some great products. Transamerica, They're capped at 500,000. They're doing non-med underwriting up to 250,000, and doing a minimum of 25,000. So where they fit and what their niche is term insurance, under $500,000, they're going to be priced really well. They got a great brand name that most clients are going to recognize over the other bunch, and their financial ratings are great. You're doing non-med or underwriting up to 250,000. So that's kind of where they fall into place. And you'll see here on this next slide, as we compare these, where their market stands and how they price. All the carriers doing a good job with living benefits. They each have their own niche, and we'll kind of highlight that as we go. Carrier or the low-cost product for each of these case examples. So we'll have a frame of reference, and this is important when you're marketing this or speaking with clients about that, is to show your clients, hey, here's where you're at, bare bones, the cheapest product out here for the amount of insurance you want. Then here's the product I'm suggesting, and this is why I think you should spend the additional 15-20%. So what we have here, female, age 35, $250,000 term policy, 30-year preferred non-smoker. These are actual quotes. Low-cost carrier in this scenario would be $222 a year. And then you have AGLA at $285, LSW, like I'd mentioned, not really their market, $397, and then Transamerica at $267. Again, that's Transamerica's market. That's really when you're going to want to be looking at trans is on these smaller term-based policies. So we'll run through a few more here and highlight, the differences. Next up here, we have an age 50-year-old male, standard non-smoker, a $500,000 15-year term policy. We have the low-cost carrier there at $1,360. AGLA comes in at $1,575 for a 15% increase off the low cost. Again, LSW, 2000, not to parade them, they do a great job on UL, but a 51% increase. And then Transamerica at $1,550. Age 40-year-old male, preferred non-smoker, $1 million 20-year policy. We have our low-cost carrier down at $840. You have AGLA at $915. That's only a 9% increase. And I want to kind of stop there, not to get sidetracked here, but that's just ran at age 40. Another one of AGLA's niches is they are age last. So that last 6 months, prior to your clients having the next birthday, AGLA gets reduced even more. So in this scenario, if this was an age last scenario, that 9% difference would probably be more like maybe 4 or 5%. LSW here, kind of tracking back to this one, $1,492, a 77% increase. That's a little bit of a tougher sell. Getting the client to pay an additional 77% for these benefits, in all honesty, might be a little bit tougher. And then Transamerica, I just included a combo quote there. They cap out at $500,000 with Transamerica. Maybe that is one of their shortcomings. But you do see those sometimes sold in a combination for a couple reasons. One, ultimately, how much does the client need of living benefits? What it really is going to be their need down the road for chronic illness or critical illness. It's not necessarily going to be $1, $2 million. So you can still sit down and say to your client, hey, let's get you $500,000 with the living benefits and then address the rest of your insurance needs. And it looks like you probably need another $500,000. Let's do that just with a low-cost carrier. With Transamerica, you can do that on the same app, get them examined once, and then get them 2 $500,000 policies. So that's nice, and that's another thing with Transamerica in your sales process. You can even tell your clients, hey, I know you want to think about it. It's a little bit of an increase. Let's just get the application in. The underwriting's the same. In 60 days, 45 days, when everything's done and approved and we've gotten your APSs, then we'll decide what exactly you want to do. Last one here is the age 35-year-old male, preferred non-smoker, $250,000. This is a UL. So I ran this at the low-cost UL. That first one there is a GUL product at $1193. You have AGLA with their GUL product. It's their GUL Plus. So there's going to be a little cash in there, but that's a no-lapse product at $1560. And then LSW, this is their low-cost current assumption product. There are guarantees in that, but it's not a fully no-lapse guarantee product. But that comes in at $1372. Comparing that to AGLA, that's about as apples to apples as we're going to get. AGLA does not really have a true, current low-cost current assumption product. Their current assumption product is even more expensive than their no-lapse guarantee. So both of those really essentially are the least expensive versions of this policy that they have in their portfolio. So LSW, only at an 11% increase. Again, we'll kind of get into really what to harp on and how to compare these products. but you're looking to bridge a gap of 11% in premium. And as we run through this and some of the statistics and definitions I've already given you and more that we'll harp on, what we really want to do is make sure you understand what we have here and how to go out there and bridge that gap to that extra 11% premium. Transamerica, not available there. This is just on term from Transamerica, but AGLA and LSW have it on term in Universal Life. So a couple case examples to give you an idea then how these are paid out, what the client's giving exactly. You'll notice here $100,000 of living benefits for $80,000 in cash. Before I kind of run through this example, that is a discounted amount, and we will go into that in a little bit here. So the client does get back a discounted portion of the total benefit that they've requested or that they've reduced out of their death benefit. Stacy, age 39, diagnosed with high-stage breast cancer. She accelerated her $100,000 living benefit insurance policy and received $80,000 in cash today. So these are real examples from our carriers. So these examples are really important, not just for you to understand what exactly is accelerated, but it is also important to use these kind of examples, and we have plenty of them. And if I send you some agent materials, you'll see plenty more in terms of how to present and show these to your clients, because you do not get preset schedules for these payouts. You can't sit down with your client and say, Bob, if you're between the ages of 45 and 50 and you're diagnosed with stage 2 cancer, you're going to get 85% of your policy. It would be nice if you could, and I'm not going to pretend it's not, that would ideally make our lives easier, but you can't do it that way. So these case examples are really important to show people different scenarios so they can kind of get frame of references as to how much money they will get back. That $80,000 is still really going to do a hell of a lot for your clients. It's going to allow, in this case scenario, Stacy receive the best care available, take time off work while still paying her monthly bills. Next one we'll look at is a chronic illness. We have Ron, age 60, was in a car accident, was no longer capable of completing the ADLs without assistance. He accelerated 24% of his $300,000 death benefit. The reason for that is this insurance carrier had capped the yearly acceleration for the chronic illness at 24% of the death benefit, and that's a common provision you're going to see. So that 24% of the death benefit of $300,000 equates to $72,000. Ron received $59,600. He was able to use the $59,600 for expenses while receiving an in-home caregiver and provide support to him while his wife was still working for another 2 years, and allowed the wife to continue her full-time job and remain the financial stability the family needed. And to note, he can accelerate this at any point in time in any 12-month span. So 12 months down the road, if he needs to accelerate more, he can. And what is important to note here is that discounting amount there, the 72 to the 59,000. One, we'll run into it as to why that's done, but what that creates as well is the motivation for the client to keep the base policy. So you don't necessarily, your client's not necessarily going to want to accelerate all $300,000 anyways. There is that motivation then that, hey, if they still have a need for the death benefit, to keep a part of it in force, premiums are reduced as the benefit is reduced proportionately. So if their premium was at $100 a month, hey, it drops to $75 a month, let's say in theory, and then they have the remaining death benefit in place, tax-free, and assuming they still have a need for a death benefit. Last one here is on terminal illness. Alan, age 79, diagnosed with terminal cancer. He had 12 to 18 months left to live if he could afford the bill for chemo. Alan accelerated 100% of his $500,000 death benefit, receiving $450,000, while he used $220,000 for the cost of chemo. At his passing, his wife retained the additional $230,000 tax-free in cash. This example here, that's a pretty large portion of the death benefit he received, 90%. The reason for that is the present value of the death benefit was higher because with terminal illness, they're closer to death. So you're always going to see the higher amount of terminal illness payments in terms of the least amount of discounting versus chronic or critical. It varies a little bit between the other two, but maybe chronic, you'll maybe see on average maybe a little bit lower payouts versus what you've accelerated. But terminal illness is by far the highest here, a full 90%. And that's to use as they choose. Hey, if he only has $200,000 in medical costs, hey, that's fine. The other $230,000 essentially served as a death benefit. So how do they calculate payments? Wanted to give you guys an idea of this. As I mentioned, we don't have exact formulas. None of the carriers out there are giving exact formulas. They're just not doing it. One, because give them the benefit of the doubt. There really isn't the exact formula, preset case examples they can give to you, but they do tell you what the input is, what they're putting in the pot, and how they're stirring the pot. So what they really take a look at then are the present values of the death benefit, present value of remaining premiums, interest rates to discount the present value of the money that they're accelerating, and then the life expectancy. And the life expectancy is going to affect what the present value of the death benefit is. What you end up with there then is present value of the death benefit minus present value of remaining premiums minus fees or any outstanding loans. If it's a cash-based policy, the fees there were a few fees listed there on that chart we looked at a handful of slides back comparing all the carriers. It's a few $100 fee. I think the lowest one we have is $250, the highest being $500. So, $250, accelerated out of that last example out of $450,000, not the end of the world. But the present value of the death benefit minus premiums, remaining premiums, minus fees are going to equate to the accelerated benefit payout. Now, that formula and that explanation is something you'll want to give to your clients so they understand kind of how that's used. Again, I would avoid really kind of penciling in or penning down any real examples for them of hypotheticals as to what they might receive. You'd hate to get a call from their lawyer in 20 years saying, hey, you put this in writing for my client. So be careful with that. But it is a good idea to give these kind of frame of reference so they understand, in any sell scenario, hey, if the client doesn't understand what you're trying to sell them, it's a lot less likely they're going to buy it. So it is important that the agent, you guys that you have and understand, this and can, present that meaningfully to the client. A couple rules of thumb then on that front. The higher the mortality, the more significant, severe the condition, the higher the present value of the death benefit because they are more likely to die sooner, and that equates to the higher payout. So that's that rule of thumb there. Conversely, it goes the other direction. The lower the mortality, the lower the mortality rate on it, the lower or the less severe of the condition, the lower the payout's going to be. And that's a good frame of reference. And I think if you just explain that generically and give a couple examples to your client, hey, stage 4 brain cancer versus, hey, stage 1 prostate cancer, obviously the mortalities are different there and a fewer severe, a disparity between the severeness of the conditions, right? Well, the stage 4 brain cancer is going to get a higher payout than the stage 1 prostate cancer. On flexible premium policies, the more well-funded the policy, the fewer premiums are due, so the benefit payout will be higher. That's just kind of your two basic rules of thumb to kind of keep in mind as you describe that. If you've marketed these products before, clients ask these questions. If you haven't, hey, take my word for it. Get used to kind of how to explain that because clients will ask that. And a lot of times we've heard agents kind of say, well, hey, they didn't like the idea of, not knowing what they got. So you want to be able to explain these correctly because that will equate to, selling these policies if you can properly explain what their benefit's going to look like. Now, it's not just protection with these policies. AGLA and LSW, if you guys have peeked at these portfolios before, I know I give you a brief example. More than happy to run sample illustrations with these. Both those carriers have really good universal life portfolios. So you can still go and sit down with your client and not just have to harp about chronic illness and critical illness with these products. You'll want to explain to them as to why maybe they're paying the additional 10%. But you still have really good cash-based permanent sales with those two products. You're not handcuffed to term insurance. AGLA, LSW, AGLA is doing primarily more a little bit of the GUL-based kind of sales and fixed assumption sales. LSW's IUL portfolio and whole life portfolio are great and in and of themselves are very competitive. So keep that in mind. General sales strategy here, really pretty straightforward on this one, I would like to think. The first one, we take a look at is just the upsell. This works great with Transamerica, for instance, when you can sit down with your client, take one application, have a couple quotes on paper, and say, Bob, hey, I really think you ought to consider this living benefits product. Here's why. Rattle off some of the stats we spoke about earlier. Hey, every 25 seconds, an American has a coronary event. Every 40 seconds, an American has a stroke, the chronic illness stats, et cetera. And I really think it's worth you spending the extra 15% here on premium. If you don't, well, guess what happens? They end up buying the base term policy. You walk out with an app. You don't lose the sale. you're just doing a head-to-head comparison upsell, and that's probably the most straightforward strategy we see. The second one there is, it's similar, but a new versus old term insurance. So guys out there with a book of business, guys out there who are coming across clients who say, hey, I already have insurance, thanks, but no thanks. This is a great time to say, well, really, quite literally, you don't even need to jazz this question up any better than, well, do you have the old term insurance or do you have the new term insurance? And if you're sitting on the phone, you might hear a little bit of silence there. If you're sitting down with somebody, they're going to kind of look at you, crinkle their eyebrows, and say, well, what do you mean, the old term insurance? Yeah, I have term insurance. I bought it 10 years ago. I bought it 8 years ago. Well, new term insurance has all these additional benefits. Here's what they're doing. This is why I'm so excited about it. And, hey, I don't want to twist your arm, but I'm really making sure I'm suggesting this to all of my clients. And everybody I speak to about life insurance is getting told the same thing. If you just want the base insurance, hey, no problem, but, hey, I'll feel a lot better about it if you at least know about these new benefits: chronic illness, terminal illness, critical illness. Health agents, I want to tread lightly on this. This isn't a supplemental solution to major medical plans. It's not. But in a roundabout way, it can be pitched that way, and it can at least you can have that conversation, which will lead down the road to these sales. As you're speaking to clients about reducing their major medical plans, groups, out there, a lot of the group insurance policies, employers are reducing benefits and skinnying things down. Health agents are getting a lot of those calls. Life agents, speaking to clients who have health insurance, you can kind of tie that in. Hey, I know your major medical has been reduced. This isn't a solution that's going to help you with your co-pays, but this is something that's a little bit larger, worst-case scenario, kind of catastrophic event for critical illness or chronic illness. And at the end of the day, you want to be careful. It's not a supplemental major medical solution, but, hey, it holds some water. So, that's another one. Long-term care alternatives on product and underwriting. So product-wise, again, we went through the definitions of chronic illness there. Those are discounted amounts, and they are still paying for the cost of life insurance in and of itself. So it's not a head-to-head comparison to a traditional long-term care policy. But, hey, you can have that conversation, or you have somebody in their 50s, 40s who's looking for a 20-year term, or maybe looking on doing a low-cost permanent UL. You can have this conversation with them, or they may ask you about long-term care and say, well, yeah, I understand you don't want to spend too much money on long-term care. It is something down the road. You're not sure if you're ever going to use it. We can still put you in this policy. It has chronic illness built into it. You will be taken care of. We can do a more comprehensive long-term care plan, 10 years down the road when you're more comfortable with it, but this is still a good solution today. And then underwriting. There are no morbidity underwriting on these policies. So I want to repeat that. There is zero morbidity underwriting on these policies. These are just underwritten for mortality. They are underwritten as life policies. Any of the morbidity-based, let's say degenerative disc disease, use of a walker, Parkinson's, etc., you can still get your client standard or maybe, table 2 ratings on a lot of those kind of cases for life insurance. Now, if you have somebody who's been through the ringer on LTC underwriting or has some of those conditions and they know, hey, in all likelihood, I'm going to need long-term care, well, hey, these products can work in that they can actually buy them. They'll actually qualify. They're not going to get rejected before their application even gets processed like they would on traditional long-term care underwriting. And then again, hey, it is an all-in-one product, one premium, one policy, one simple solution. We touched on that, but that's kind of another area we're kind of seeing these sold it for nothing else. People do like that idea. They don't have a carrier out in Iowa, a carrier, back in Nebraska, and a carrier in Texas with 3 or 4 different policies. One premium's drawn on the 3rd, the other's drawn on the 17th, one on the 21st. If they have some of these other critical illness or chronic illness-based policies, which, as I'd mentioned before, on a standalone basis, those are popular products. You got a lot of people out there selling them, and a lot of carriers marketing those. So you will come across this clients who already have those different forms of products. You can roll this into all one simple base product, one premium. Another concept I want to push to you guys here on this today is just the idea of throwing a larger net with these. You don't need to sidetrack or develop a new marketing plan necessarily to market these products. It's more just throw this out there. The upsell strategy I gave you, you sit down, you have 2 quotes on it. As you speak with people, market to people, throw it out there. You're not going to lose any of your base sales, what other strategies working for you in the meantime, but just throw a larger net. You're going to catch a few more fish with these. There's going to be a couple people out there that turn their head and their ears perk when you say living benefits and life insurance you can use while you're living today. life insurance you can use for long-term care, life insurance you can use if you have a heart attack, if you have a stroke. So it really is a larger net in that you're going to catch more fish out of it, and I really want to harp on that in terms of it being a little bit of a no downside kind of a pitch. There really is no downside. We mentioned a lot of the carriers are the same, underwriting's the same, commissions are the same, and you're not going to lose your base sell on these guys. So to wrap up the stats, to put everything in perspective, these are really based on just multiples of what we looked at before. So far this year in 2013, 920,000 Americans have been diagnosed with cancer. 750,000 Americans have suffered a cardiovascular event. Over 10 million Americans are receiving long-term care services, and 1.5 million Americans have passed away. This is protection your clients need today. This isn't fluff. This isn't sizzle. You know, we're not going out there selling our clients empty promises when you're marketing these products. These are very substantial marketable products that your clients need. They really do. These are great products. They are higher premium. You're going to make a few more bucks for it. As we mentioned, comp schedules are the same. So at the end of the day, it's a win-win. Your clients are getting protection they need. You're making a few more bucks on it in terms of comp, and then you're going to get more sales out of this stuff. So it really is something that they need, and it really is something you guys ought to be marketing. That's it. So I'm going to open the floor here in just a second and mute the call for questions. Like I said, my name's Sean Giroux for those of you who rang in late. My email is sean@imsforyou.net. My phone number 800-914-9483 at extension 7342. imsforyou.net. The webinar will be posted on there. We'll be sending out that link, if not this afternoon, by tomorrow morning. Again, thanks guys for ringing in. I really do appreciate it. I'm going to open the floors for a Q&A, and please, if you guys have questions, you know, hey, there's bad questions. Bad questions are better than no questions, so please ask away. So you've been unmuted, everybody. You can fire away with questions.
Sean, Dave Downing.
Dave, how are you doing?
I notice this fits well with term, but of course on term, it's going to end at some time, and it seems like you'd almost be forced to go to the universal life.
No, I mean, not necessarily. You know, there's a need for temporary insurance on these, and at the end of the day, there's a premium crunch. All things being equal, we'd all want $1 million of insurance guaranteed to our ages 121, but the realities of the scenario is we're not all willing to pay the bill. So, you know, I disagree with that. The other thing is those products are convertible. The majority of this market really actually is sold on a term basis. Again, you know, those critical illness, chronic illness, they're more relevant for elderly, as are the death benefits in of themselves. But if you're speaking with a 35-year-old with a new mortgage and 3 children, it may be a little bit tougher for him to buy into the concept of permanent insurance. Temporary insurance, term-to-perm idea there is something you see from the carriers, you know, in the old marketing strategies. It's still relevant. Hey, buy term today, 5-10 years down the road, we can convert. So
okay, so convert to universal life might be the thing to say you do after your term runs out.
Yeah, I mean, ideally you do it, you know, in the earlier years, so they're still converting at a lower attained age, but absolutely.
Thank you.
Yep.
Sean, I'll continue to
What was that?
All right. First off, what is morbidity underwriting?
Morbidity underwriting is the underwriting for sickness, injury, sickness, and disease. Illness and disease underwriting. So that's the likelihood that the client's going to incur an illness or a disease.
Okay.
Versus
the other
mortality
thing
is underwriting for death, right? So that's the distinction there. Mortality underwriting, they're underwriting for death, aka life insurance. Morbidity, they're underwriting for illness or disease, injury, illness, or disease.
Right. So we get life underwriting is what you're saying.
Yeah, exactly.
I guess the only thing that I don't see is any super disability income. We're not really offering that, but you are covering chronic. in
Correct.
critical.
Yeah, it is separate from DI. It's not an income replacement. When you compare DI with long-term care, chronic illness, the biggest discrepancy is disability income is a replacement of income. It's an indemnification of lost income. Chronic illness and long-term care are not indemnification of lost income. You're going to qualify in a lot of the same ways, but it is not an indemnification of lost income as disability income products are. And to note, by the way, a lot of these products actually have disability income riders you can attach to them.
Okay. So we've got 3 companies right now licensed in California that you're talking about.
Correct.
Super. Thank you.
Yep.
Shan? Hi. I have a question. For those chronic disease, the example you show, like $84,000, do they get one-time lump sum pay, or it was paid over the
One-time lump sum pay.
It is a one-time lump sum.
It is lump sum. Correct.
Okay.
Yes.
Thank you.
Sean, Gary Ledger.
Hi, Gary.
Hi. So you're not including United of Omaha with their chronic illness as one of the products that's approved?
No, we're not. You know, these living benefits really are that total critical illness, chronic illness, terminal illness. So, you know, not to collude the waters on it, the Mutual of Omaha product is strictly chronic illness and is only available on one of their products, their GUL, and only up to $250,000. So it's nice, and when you compare GULs from $100,000 to $250,000, Mutual of Omaha is relevant, but it's a little bit more limited in scope.
Got it.
And it does not have critical illness, by the way. It is just a chronic illness definition in that Mutual of Omaha product.
Okay, and so the idea of converting from term to UL and still having the critical illness and chronic illness, that doesn't work for Transamerica, but it does work for AGLA.
Yes.
It does work for AGLA and LSW.
It works for AGLA and LSW.
Got it.
Yep.
Shan, another question. Once you trigger those diseases payment, you just answered my question. It's a lump sum payment. Once you trigger that, there's no point of return, right? You can't say they take it and then they recover from disease. They can pay the money back and resume the insurance.
No, so that is a permanent reduction of the death benefit. Just to kind of touch on that a little bit, we didn't go into claims at all on today's webinar just because, you know, we wanted to kind of keep it a little bit more condensed. But that process here, just to touch on it briefly, they submit the claim for the qualifying event, and in addition, submit the amount of insurance they want to reduce. Now, on a $500,000 policy, they may say, I want to accelerate $250,000. They may end up receiving, let's say, $200,000. So their death benefit will be reduced permanently from $500,000 to $250,000. They receive $200,000, and then moving forward, their premium will have been reduced more or less by 50% as well. There's price banding, and there's built-in costs on those products, obviously, policy fees, etc. So you're not going to see a complete 50%, you know, prorated reduction in premium, but you will see a permanent reduction in premium then as well. Next year, they recover. If they wanted additional insurance, they would have to reapply. They can, you know, pay the money back and then, you know, reassume a $500,000 policy. It is a permanent reduction.
Okay, thank you.
Okay. Any other questions there, guys? Those of you who are still on, I think we're whittling in numbers. Open the floor one more time for any additional questions before we shut down today. Alrighty. Well, hey, thanks again, guys. I appreciate everybody ringing in. I am available for questions, so anything later this afternoon or next week or the end of this week, please give me a call. Keep an eye open for the email with the base presentation and the link to the webinar if you want to freshen up on it or listen to it again sometime down the road. Thanks much, guys.